had a couple questions come in about strategies in the current market, how to keep profitable and sane in a volatile market that we've seen recently. Direct questions. The first was from Mike G. Sent me an email on Wednesday. And he says, my question is, how is anyone able to successfully trade the market as has been the last couple of weeks? I'm afraid to get back in. Which option trading method would be the safest? What criteria should I input for the best results? It's extremely volatile right now. I love all the tools in your website, but I don't know if I should use the hammer or a screwdriver these days. And earlier this afternoon, I think it was around 2 o'clock, maybe 3 o'clock, Len commented and says, I was mostly in cash when the market went down. There are several people who did that, I'm sure. The balance is in the married puts, which is only down about 3% in diverse, and just sold one oil stock at a profit. Until the market comes back, about the only way I figure to make any money is with credit spreads, since they can be bull or bearish. Maybe, but maybe not. The swings have been so crazy, I'm afraid I couldn't get out of as a losing position and a reasonable loss. A very reasonable thought to have there. And since most stocks follow the market, which can switch directions on a dime, picking winners is certainly harder. Do you guys have any suggestions on that, or perhaps even better strategies for high volatility markets? Well, let's take a look at the year to date. We do see sort of a consistent trend, but what has gotten us has been the gotchas that have come out. We saw the decline in the beginning of January, a fake recovery, I'd say, in the beginning of February, sort of a stagnant period through the middle of March, a fake rise up there, and then the big back decline once we got back up to 460, all the way down to almost 380, a little bit below it actually. And then in the last couple days, we've just jumped right back up, and now we're at about 415, 413 or so in those cases. So this has been tough in these positions. Now, there is not one strategy that worked through all of these cycles consistently that I can think of. There are strategies that were open. There were strategies we discussed. There were strategies that we traded. But management was always key. There was no fire and forget position unless you had perfect market timing. Bought puts right at the end of March, beginning of April. Bought puts on stocks or on ETFs and indexes, or we're doing bear put debit spreads right at the beginning of January. Maybe some iron condors in that end of February, mid-March period. Okay? We can see the difficulties, and we've all lived through it, so we know what they are. What was the community focus here at Power Options through the webinars, coaching sessions, and everything like that? Early in the year, we had discussions on bear put debit spreads. We talked about how Ernie was buying puts, and then when he had a profit on those puts in mid-January, he would roll them down and convert them into a bear put debit spread. Sort of almost some of them were actually bulletproof bear put debit spreads. We talked about out-of-the-money bear calls, or 30, 60-day out at-the-money bear put spreads that had closer to a 1-to-1 risk-reward ratio. In other words, if I had a 5-point debit spread I was looking at on an ETF or a larger stock that I was bearish on, and take your pick, as we saw in those first couple of months, really. And, of course, in that last cycle, they're going into the bottom here from April down to about 10 days ago. If we had a 5-point spread, we were paying maybe a debit of, 250, 270, and 280. So we're looking to make 220, 240 on an investment of 260 or 280. So we're close to a 1-to-1 risk-reward ratio. In the beginning of January, first week, we talked about calendar put spreads, turning off the bull call debits, backing away from the bull put credits, which I usually talk about in good market conditions, looking at buying maybe 5 to 6 months out. Most of mine were maybe in April or in May, actually, at the time, so 4 to 5 months out. And that was before the IV spiked, before the VIX spiked and those puts started to get really expensive. And then we were going to sell shorter term, 14 to 20 days against it, in a bearish structure, where let's say if I had bought a 410 put on SPY out to April, I might have been selling 400 or 390 puts against the position at the lower strike to create a bearish calendar spread. But as the market turned, if it started to go back up above 410, as it did in that one section that we saw there going after March, then we could always switch it and keep that put, although it was losing value at this time, but selling the higher strike puts against it to continue to bring down the cost basis. You could do that with the calendar calls too, starting off with a bearish structure and then converting to a bullish structure if it started to move back up. Again, it wasn't a fire and forget position. It wasn't just like holding a stock and selling a call out of the money, and hoping the stock didn't fall too far. We're moving from bullish to bearish in that structure potentially. Also, there were a lot of presentations and discussions on management of existing positions. Was it a good idea to roll to lower strikes below the cost basis on the covered calls or the naked puts? How do I roll it deep in the money naked put? We discussed preferably adding puts to your covered call plays, still generate income, but now have protection to keep losses low, even as the market was declining, or even add a put to create a bull put credit spread or maybe a bear put debit spread as the stock started to move to or below your naked or cash secured put strike price. Other ideas that we've discussed entering into unknown markets before. In the beginning of January, we talked about setting up maybe 3 to 4 month out strangles. A gentleman that used to join us regularly for our presentation, Sam, he had been doing this for years in the bull markets since the recovery after 2020, buying a strangle 3 to 4 months out in time, or sometimes just buying a call on SPY if he was bullish and we saw the market turned, he would take the profit off that and buy a put. I didn't know what the market was going to do, so I took smaller positions, buying a strangle, an out-of-the-money call and an out-of-the-money put, SPY, QQQ. I did one on RUT that worked out okay too. I'm sorry, IWM. My apologies. But again, it's not standalone. As the market moved down, I'm losing on my call, but I'm gaining more on the put. And when I hit a certain trigger, I might look to re-bracket the entire side, move both options down. And if it started to move back up, hey, the new call would start showing a profit as I'm losing at the put, but I pocketed some of the profit from the initial position. Wasn't holding them all the way to expiration. You got to keep moving and adjusting them. And depending on how much time you're willing to devote to these positions, it might not be a good one. We always talk about buying shares of volatility ETFs, maybe calls on the VIX when the volatility is lower. And we just had a discussion on using other market hedges beyond gold and silver, because gold and silver were going down the same time as the market during that April decline into May, up until, again, about 4 days ago. We've been 7 weeks in a row down up until recently. Gold and silver were declining as well as the dollar got stronger. And that was the reason why. So there were volatility plays to not only help to profit somewhat, see some gains in the market, but more to hedge against these leveraged positions that aren't going your direction. If you did open bull call debit spreads or bull put credit spreads, this is a portfolio hedge that can help counter the losses on these positions while you're trying to manage for a better range. Recently, we talked about some new plays, buying small calls or puts on sector ETFs that were showing strength during earnings. Calls on oil and natural gas ETFs as you go through the spate of earnings, and the oil companies were showing new record profits again and things of that nature, bringing everything up as the price per barrel went up, and we're all feeling it. Also helps a little bit to have that in play to help with the price at the pump. And we talked last week about the puts on the retail ETF XRT when those terrible earnings started coming out, and it worked well until it didn't work this week. Everything started to come back up. We were adjusting and closing positions at a 40-50% profit on some of the contracts we had on XRT, and then closed the last segment of 1 or 2 contracts in the last 2 days for a small loss. Overall, it was profitable, but Ulta Beauty came out with great earnings and popped up in price, as did other ones. But a couple days ago, Abercrombie & Fitch, ANF, was down about 30% at one point. So it worked well until it didn't. What is the safest play? That was part of Mike G's earlier question. And how can we avoid market volatility? Well, that's exactly what the married put structure and standard collars do. The married put, of course, as we talk about in the blueprint, we keep protected on core holdings. I have a stock that's down 12%. I'm at a 1.5% loss. I had a stock that was down about 9% from where I purchased it, just closed it last month for a 1% gain, small gain. Especially for the time frame I held it, about 6 months, 5.5 months really. But again, the stock was down 12%. I had a gain of 1% following the married put structures. The collar position's just like a covered call. We buy a stock, we sell an at the money or just out of the money call, but then we buy an out of the money put. We still keep a premium. If we get assigned, if it does move up in our position. You can use a slightly in the money covered call for a little bit more protection on that too. But if it moves up in price and you get assigned, you could still make 2.5% maybe for a monthly, not a weekly, for a monthly. But you're only risking 3.5 or 4% to the downside in case of an uncertain market if it just falls. You can always rebracket the collar. And there is a way you can reverse that structure, be long stock, but create a bearish collar. Why would I do that on a long stock? Well, if you're only on level 1 or level 2 trading, which allows you to buy puts, but the puts are expensive in this volatile market and in the declines, so you got to pay more to do them. It's not the money. If you could buy the stock, I understand, but I could buy the stock, let's say at 50. I could sell a 50 strike call and buy a 55 put. I might have a total cost basis of $53.50 in this position between the call premium and the price I paid for the put. But if the stock falls and is below 50, my call expires worthless, and I force someone to buy my shares of stock at 55. I still make $1.50 on that position in a bearish market. And if I was wrong and the market went up, I was only risking 3 to 4% to the upside, and we could rebracket the collar to a bullish structure later on. So these are some ideas here, but this is what we were looking at. This is basically how my year's gone. Looking back at the notes in my portfolio and Power Options and looking back on the posted webinars that we had on YouTube. In that first month, January to February, I was managing married put positions, sometimes adjusting the put, sometimes adding an extra put perhaps. And we were talking about those bear put spread ideas, ways to manage a bear put debit spread. During this time, we also had a lot of conversations on managing bull call debit spreads that were going against you, managing deep in the money naked put positions, and covered calls that had gone against you. But we talked about the bear put ideas of just a straightforward bear put, maybe the at or out of the money bear put, that closer to 1-to-1 risk reward ratio, 40 to 60 days out in time, and what Ernie was doing with buying puts when he got the profit, rolling them down, and then creating a bear put debit spread, which might not have any risk. And we talked about the long strangles on SPY and QQQ, most which were out to April. I should have put more out to May. But again, those were all rebracketed. In February, I started feeling froggy. Saw SPY give me a fake out, let's call it that. Jumped above the SMA 20 in that case just for a little bit. So that first week, I opened 3 bull puts. The next week, I opened another 4 bull puts, all for 2 weeks out in time. We had to manage 3 of the 7. We used the pendulum adjustment, so all of them got out with a small gain or no loss. But 3 of the 7 had to be managed. It was tough. And of course, still married puts are open in this position, and we're taking a look at the strangles. Now, in and around between March and April, now we get that positive signal of SPY above the 20-day moving average. Started looking at standard collars. Not as long-term as the married puts, 30 days out. The additional structure I mentioned, bullish structure, buying the stock, selling an at or just out of the money call, buying a further out of the money put, controlled risk with the potential for income in an increase. Now we're managing the married puts back up with other income methods, but we have to start managing the strangles now as the market's moving up because the profit we have on the put side of that strangle is starting to evaporate. We want to rebracket it, get it up there so that now we can start maybe profiting in the direction on the call side. Although, yes, we know we're going to give up some value on the new puts as we rebracket. April, hesitated, moved down, hesitated. Doing bullish income methods on the RPMs before a big downturn happened. It was a good time to do it, and if it rebounded, we could still adjust those. Still looking at the collars, missed opportunities, personally, for new bear put debit spreads or new bearish spreads around mid-April. Once it started to give that little head fake again, it dropped below the 20-day moving average, started to come back up, and then we got slammed down. So honestly, yes, this last month, 12 days into May, I wasn't opening any new positions. I was letting those strangles go. I was not in any more bull put credit spreads. I still had a couple calendar puts I was managing at this time. And I didn't open any new collars yet because of the downturn. But as we got into earnings season, that's when I started to look at the earnings plays on those ETF positions. You know, bullish ones that are starting to show good, and they still have 5 or 6 more in that sector industry to report in the next couple weeks. So looking at calls. Retail started to look terrible right off the bat. We saw those discussions in the outlook for the next quarter even being negative with increased inflation and prices. So that's when we were looking at puts on the retail, which again worked up until the last 4 or 5 days. Didn't take as much profit as I should have had because again, this is something new to me. I'm trying out, and I'm learning as I go. All right, that's how we are all doing actually. So Mike and of course the other gentleman that sent the question. That's what we're looking at. All right. Now, I had a call from a customer on Wednesday, May 25th. He had a basic question about the tools, and he told me he's been really happy with the monthly naked puts. And I thought that's odd in this market. Then I did a back test. Starting from December 23rd, the Monday following standard December 2021 expiration up to May 21st. We took an account with $100,000, allocated 25% to the first 4 trades of the default monthly naked put picks of the day. A little bit different than how Ernie did it. He did 100,000, and I think the top 2 or the top 3 trades. I'm doing 25% to the top 4. Anyway, used a 10% stop. The ending cash on hand on May 21st was $105,000. That's 5% in 5 months, but not bad for reasonable range out of the money. Not a loss. I put a dash there. That was terrible. It was up, as you can tell, 5.1%. Now, it's a 70% win ratio, which is less than we'd normally target. 14 wins and 6 losses. And the average win was 3.2. The average loss was 3.6. 4 of those 6 losses came on the April cycle. Opened on 4/22. They were all closed. I'm sorry, right after the expiration date of 4/20. They're all closed down on 4/22, by 4/25, excuse me, due to that 10% stop trigger. Prior to that April series, if I had done this with just the top 4, and backtesting is no guarantee of the future and no guarantee what the actual market would give, I understand that, but it's what we have to do to gauge on it. But at April expiration, which I think was the 19th, there were 14 wins and 2 losses, and the account value was $109,000 before those 4 losses all triggered 3 days after they were opened on April 25th for the May cycle. That's not too bad. 4 months, 9% return, a little bit above 2% per month for out-of-the-money naked put positions. That's a reasonable target. And I was surprised that they had been performing so well. That's just the default screen. I was kind of surprised at that with the recent market conditions. Does that mean I'm going to start looking at out-of-the-money naked puts? It might be. And if a naked put starts to go against me, I may still have the opportunity, depending on the price, to convert it to a bear put debit spread if the market turns back again. Sounds strange, but taking a deeper look at it, monthly over weekly, looking at some other tests for credit spreads briefly that I didn't get to finish, and also the monthly over the weekly covered call structures, it seems the weekly positions have been more difficult. You can't go as far out of the money selling puts, bull puts, or bear calls going 7 or 14 days out. You have to stay closer to the price to get the reasonable return that you want. And you're taking in a lower premium, which means those swings that happen during the week are hitting triggers too fast, and you're getting too high of a loss because less premium was taken in as opposed to a monthly. So I think, I'm not sure on this, further research is needed, but I think in this market, covered calls in the money for protection and out of the money naked puts can work. But I think we're going closer to 30 to 45 days out. Deeper in the money on the covered calls, deeper out of the money on the naked puts in order to try to keep the win-loss ratio where we want and not lose too much. But as I mentioned, I put in a stop of 10%. I think Ernie uses 7 on the weeklies and maybe a little bit more on the monthly structures. But management is key. There's no fire and forget position that you can just put on, walk away, come back at expiration, and assume you're going to be okay. Other than potentially a married put or a collar position, which again for Mike G is the safest thing in my opinion that you can do in these markets because you have controlled risk to single digits in those strategies where even if the market bottoms out or sudden surprise or another black swan hits, you've controlled your losses to less than 5% in most cases. But the most important things, it had been mentioned, of course, in that the other email there that I can see credit spreads as the only ways you can go bullish to bearish. Well, you can go bullish to bearish in debit spreads. You can go bullish to bearish with calendar spreads. right? I can set up a calendar put spread as a bullish structure or a bearish structure, depending on what I want to do. Same thing with the calls. I can make that a bearish structure, similar to a bear call credit spread, just one option is further out in time. Or I can use it in the proper structure as a bullish trade. Proper position sizing is key. That's what I wanted to get to for Len. If you think credit spreads or debit spreads are the only way you can make money in this market, if normally you hear me say, oh, well, you should use 10 to 20% of your portfolio in credit spreads because of the lie of leverage, you can't allow a credit spread to go beyond a 50% loss period or a debit spread to make them work. You have to close them or adjust them when they start to hit that point. But in uncertain markets, even when I said I opened those 7 bull put credit spreads starting in February during those 2 cycles, my normal allocation is 15% of my portfolio. It was half of that. It was only 7.5%. So if these went against me, I would only be losing 3.5% of the total portfolio. Reduce the exposure in those. If you normally use 10, 15, or 20% into debit spreads or credit spreads, cut it in half in uncertain markets. Hedge. Hedge new positions that you're bullish on if you're buying stock as a collar or as a married put position, and use those other hedges we talked about, buying shares of volatility ETFs, buying shares of inverse ETFs on SPY or QQQ, for example, to hedge that spread portion of your portfolio, which can quickly go to a 50, 60 to 70% loss of what you invested or the margin if you haven't in there. As I mentioned, we'll have more on this soon. I didn't get to it as fully as I wanted to in this case, so we will get to more of this, that research I mentioned, but I just wanted to give some ideas to Mike G and Len of what we've been discussing as the community here, what we've been looking at in our personal accounts, ideas going forward with some of the strangle position, perhaps holding off and waiting to see what the market starts doing next week and over this extended weekend before deciding if we're bullish and bearish, even though we've had a nice break and a nice last 3 or 4 days of trading after 7 weeks of decline, had about 4 days of upward movement here. But is it a fake out again like we saw before? Okay, so we'll have much more of that in the near future. I promise you that. We just have to do a little bit more research. I just didn't have the time to get all that together.